The top picks. Kakaku, they are an online player in Japan, including restaurant reviews.
Yeah, so think Yelp. They've got the number two restaurant review search and reservation website in Japan. They've also got the largest price comparison website. What's really interesting with Kakaku is that they then will also spawn new websites, new web-based services. So this is an asset-light business because, of course, other than the cost for the engineers, there's not much capital investment in terms of bringing these new services online. They are also one of the few global businesses that we've come across where they have a return on equity target, and their return target is 40%.
Whoa.
So we love companies that think like we do, which is focusing on return on capital, because of course, return on capital over the long term is the single most important metric that matters to shareholders.
Pretty high return on equity.
Yes.
Credit Acceptance, pretty boring name, but they're a player in the subprime auto loan business.
Yeah, boring name, arguably boring industry, and we like boring industries because, of course, they don't generally have lots of competition. Credit Acceptance is a relatively large player. They have about 10% market share in the subprime auto lending market. But what really attracts us to them, again, starting to sound like a broken record, is their capital allocation strategy. They are extremely disciplined. So I'll give you an example. When interest rates are low and credit is free-flowing, you can imagine there's lots of competition to issue loans, and therefore the spread on those loans goes down. During those periods, Credit Acceptance will actually pull back as their competitors pile in, and Credit Acceptance will either pay down debt or buy back shares. Fast forward to, say, a period like today, where credit is tight, interest rates are higher, and competition is slower or less for Credit Acceptance, we see their loans year over year up 20%. So they zig while others zag, and they are very disciplined capital allocators.
Isn't it a worry, though, that the auto business will slow down here?
Well, I mean, perhaps. They're providing loans for used cars. So this isn't necessarily new cars. To the extent that people still need to get from A to B, and the car, at least, for example, in places like the United States, is still the primary form of transportation, that's not necessarily a concern from where we stand.
Okay. And your final idea, a Scottish-based company called Calnex Solutions.
Yeah, so Calnex is a relatively new position for us. We've held it for a little over a year. They make testing equipment for networks. So their clients are sort of the big cell companies like Verizon, as well as data centers. So Meta, Google, et cetera, et cetera. They sell a durable good, and remember I spoke earlier in the show about how we favor recurring revenues. They don't necessarily have a really high amount of recurring revenues because they're selling hardware. And what we found over the last year is that these hardware sales, it is cyclical, and it really depends on the budgets of their end customers, which right now are a little bit constrained. Having said this, they are founder-run, founder-owned. They have no debt. They have strong returns on invested capital. The reason that they are a relatively little position for us, so about a 1% weight, is because they do sell durable goods, and also they've only been public now for, I think, just a little over 2 years. So we would like to see more evidence that their business model is able to continue to generate strong returns on invested capital. So we keep tabs on them and look to hopefully increase our conviction over time.
What about the Gillette thesis? It can be very desirable to have companies that they sell you a bit of equipment and then they keep selling you spares, etc. Right.
So, yeah, that's a great question. So these cell phone networks, they go from 3G to 4G to 5G, and they will only continue to evolve and get better. Yeah. And you'll need new testing equipment for each iteration of those networks. Yeah. Not only that, but they also provide warranty support. So, if you've got a problem with the equipment and you're part of their warranty support program, which is recurring revenues, and that is increasing for them. But still, at this point, they still are a durable goods company, and we're a little bit leery of durable goods companies at times.
Yeah, it is interesting how many companies are now going to the streaming model. You probably see that some car companies are trying to charge you a subscription for features of the car.
Right, yeah, and so they're really trying to copy that SaaS, the software as a service model, subscription type model. Yeah.
Because it's interesting, you sign up for a service and sometimes you just forget you've signed up for it.
That's the thing. I mean, it's on your credit card or it's coming out of your bank account and you don't even notice it. And that's what companies hope is that the ideal hope is that you're enjoying the service and the subscription, but for maybe a lower quality product or service, they maybe hope you forget about it.
Yeah, human inertia, it can be a good thing to bet on.
Yes.
Yeah. I think it's interesting as well. You buy an electronics product and you don't seem to have full ownership of it anymore. I mean, they can mess with it, mess with the software.
Right. Upgrades and so on and so forth. Yeah.
And you don't have the right to go and repair it as well.
Right. It's certainly a lot more difficult these days to repair electronics and mechanics. Yeah.